Grace Rains, and today we're going to talk a little bit about financial structures and terms. And I'm joined today by Quinn. Quinn, you want to tell us a little bit about yourself?
Yeah. Quinn Robertson, run the 412 Angels Network up in Northwest Arkansas, trying to just basically build out education and get more folks active and involved in this angel investing asset class. So it's been a lot of fun.
Yeah, so today we brought you in to talk about financial structures and terms. So we really, hitting you with the hard stuff today.
Terrifying, let's do it.
Yeah, so I want to start off just like launch right into it and talk a little bit about the difference between priced equity, convertible notes, and convertible equity, and what the difference between those three deal structures are, and just jump right in.
Let's do it. So let's start with like the most vanilla and then work our way through.
Okay.
So originally, when you think about like what you see on Shark Tank, you see someone giving a little bit of money for some equity percentage ownership in the company. That's like the most standard way of doing things. And so that would be a priced equity round. I am buying shares, new shares in a company at a certain price, and I have equity ownership and life is hunky-dory on that front.
Yeah.
Because I'm a preferred shareholder, I get some super special rights and things that come with those shares that the common shareholders like founders or early employees may not necessarily have, and we'll get to those here in a little bit, but like fundamentally it's a little bit of a fancy version of just straight equity in a business. Now, we decided to make things a little bit more difficult and say, okay, what if we don't necessarily know what the price of the company is? Maybe we don't necessarily know, or maybe we want a little bit more downside protection. So we introduced a convertible debt instrument, or sometimes a convertible note. Think of that as I own debt today, and it's probably a certain amount of money with an interest rate, but really I'm going to convert over into equity at some point in the future. So it's debt today, but I really should be thinking about it as equity, and I convert over at some specific terms related to that. And then we said, you want to know what? Convertible notes are really, really tricky, and they get really, really long, and there's a bunch of legalese involved with them. And so we created a document, or Y Combinator, a really, really great accelerator, created a document called a SAFE, Simple Agreement for Future Equity. And the long and the short of it was, it's like a convertible note, except it's just a lot more clean and vanilla. And so we basically only negotiate two things. And so we can dig into some of those a little bit later, but fundamentally, regular equity, which is price preferred equity. You've got like a sort of equity instrument, convertible notes, convertible debt. I convert over to equity at some point in the future. Safe notes, just the more vanilla version of a convertible note. And those are the three main ways that we invest in those.
So what of those three, which you tend to see the most of, which tend to be utilized the most by angel investors or early stage investors? I
would say, especially nowadays, priced equity or safe notes. And I would probably see, I see more safe notes these days, especially at the earliest stages. At the earliest stage of the company, you have no idea what the valuation of the company is. You also don't want to go hire a lawyer to go build out these ridiculous financial documents or investment documents. And so an investment structure that you can download off of a website, fill in two things, and life looks pretty good, and you can get things done in like 10 minutes. Those are what I see most frequently at the earliest of stages. Once you get to later stages, probably more preferred equity. Convertible notes I don't see nearly as much, especially as the SAFE has risen in popularity. I've seen less convertible debt instruments, and there's a bunch of different reasons for that, but probably much less of those than I probably saw 4 or 5 years ago.
Yeah, no, that's great. And so I want to dig into something you said about kind of the lack of a need for evaluation. So let's talk about which of those require a valuation number and which don't.
Yep. So your priced equity, you do need a valuation, right? That you are buying into the company at a certain share price, at a certain valuation, and so that absolutely requires a valuation. Your safe note and your convertible note, both of them, you're not really setting a price today on what I'm going to be investing in. You kind of are. The quick mechanics on it are, if I'm a safe holder or I'm a convertible note holder, I'm debt today, but let's say 2 years from now you raise money at a different valuation. The term that's involved in both of those is called a valuation cap. And really what that means is I convert over at the lesser of the discount to some future valuation or that capped valuation. And so sometimes people sort of equate that valuation cap with the valuation. Technically, it's not. But I sometimes do tell folks to think about it as that's the price I'm paying today, and so that's a way I can think about as what's the value of the company. But at least from a technical perspective, priced equity is the only one that has a core valuation that you're investing at.
So any other pros and cons between the three that you feel like help differentiate them?
Yeah, you have much less rights with a safe note and with a convertible debt instrument. Okay. You're not an equity holder, right? I have no say on how the company is run. I have no voting rights, all of those types of things. And so the ways that I can influence the business are just much more minimal from a contractual perspective on that front. If I'm a preferred shareholder, I have certain rights that come with those shares, whether it's access to certain pieces of information, certain votes that require my involvement. And so in those instances, that's probably the main difference between the two relative to not necessarily pros and cons. At these earliest stages, you're not necessarily operating the company day in and day out, but you want to have your the pulse of what's going on with the company, and so having those rights contractually is a positive. I will also say you can invest on some of these other structures, and if you have a great relationship with the founder, they're going to give you that information anyway. And so a lot of it is just really what's on paper more so than anything else.
Yeah, absolutely.
Yeah.
So there's two different terms I want us to introduce before we kind of jump into them. One of them being term sheet. So
Yep.
let's talk about term sheets.
So a term sheet is when I make an investment into a company, there's two pieces of paper, two kind of legal docs that really exist here. You have the legalese, 15 to 25 pages if it's a priced equity round, of the legalese of here's contractually what I'm signing up for, what I, as a new shareholder, get, the operating components of the company. It's all of that exists behind the scenes. And then you sort of have like a summary of it, like a non-binding summary version of it that's like 1 page to 2 pages. That's like, this is what kind of we negotiate on. We sort of understand like what's going to end up in the legalese. The term sheet is just sort of the summary version of that has certain components related to economics, certain components related to management and control, and what I as an investor get as a part of this investment as well. The other part of it as well is this term sheet most of the time really only exists with priced equity rounds. Sometimes you'll see it with convertible notes, but mostly it's only priced equity rounds. Because a safe note, you fill in two things on a piece of paper. You're not really needing to go through all of the summarization. It's just those two items. Priced equity rounds, you do need sort of that summary version to help with the negotiating process.
Yeah, no, that makes sense. And so the other term I want to talk about is cap table.
Yep.
So what is a cap table? How does that work?
So you have a company with 100% ownership. A cap table, longer form capitalization table. How is the company capitalized? Who owns the company? And so a cap table is either in a piece of software like Carta, or it's on an Excel file, and it's simply a listing of who owns what in the company, right? How much do I own? What number of shares do I own? What percentage of the company do I own? You frequently will also see them in a historical context, so not only like what is it today, but what was it historically, right? If a startup is likely going to be raising multiple rounds of funding, and so who owns the company 4 years ago is probably going to be different than what it was 2 years ago than what it is today and 2 years from now. And so there's also sort of this historical and future context that you also sort of build in there. But that's really what it is, listing of who all owns the company.
So we talked about investor terms, economics versus control, and kind of what those terms look like. I want to dive into that now.
Okay.
Let's talk about valuation first.
For sure. So think about valuation. When you're investing in stocks in the stock market, it is price per share. I'm buying at $3 a share. Because every company has a different number of shares and yada yada, we simply say, what is the value of the company? What is the valuation of the company? And so that's probably the biggest economic component that we really negotiate in the negotiating table, right? Am I buying 10% of the company, or am I buying 48% of the company, which is significantly different? And we'll get into sort of the specifics around that, but think of it as the valuation, how much I'm putting in, is very much a how much of the company am I going to own?
Yeah. Absolutely, and I do want to dive more into valuation and kind of the economics behind that. But next I want to talk about kind of pro rata rights and liquidation preferences and how those can kind of play into each other and when you want one versus the other.
For sure. So liquidation preference and pro rata rights, I think of them as rights that are helpful for you in the future depending upon if things go well or if things don't go well. So think about in the future, right? These companies are raising a next round of funding in 18 or 24 months. If the company's doing really well, maybe I want to own more of the company, or I want to maintain my ownership position. Pro rata rights simply are they let me maintain the ownership in the company that I have by investing a little bit more in the future to maintain my ownership position. So if the company's doing really well, I want to own more of my winners.
So I get like first right of refusal to keep my rights.
To keep my ownership
equity.
percentage. That's exactly it. Now the other side of the coin is at some point in the future, if things aren't going well, maybe the company gets or is thinking about selling for less than what I invested in, and maybe things aren't necessarily going well. A liquidation preference is a something that's helpful for you in the future when things aren't going as well. Basically, it's if money is going to come into the company for an acquisition or merger or something like that, I get to get my money out first as a preferred shareholder before any of the common shareholders. So simply, it lets me get my money out first, and we represent that as a multiple of what I put in. So if I invested $10,000, it lets me get my $10,000 out first. That would be 1x. Maybe it's 1.5x, 2x. So I would get $15,000, $20,000 before any of the common shareholders get anything. Okay. Normally, it's 1x, i.e., I just want my money back first in case there's just pennies on the table and people fighting over scraps. So, yep.
Absolutely. So next I want to talk about drag-along, tag-along protections. What are those?
So drag-along, tag-along frequently is involved with simply you are a very minority shareholder. You have some big, likely, some big institutional investors that are at the table. Really what those rights are associated with how can, if there's a big decision to be made, a vote to be had, it doesn't allow a small minority shareholder to hold up certain things, be it an acquisition, be it a vote, whatever it may be. So likely you're going to simply tag along with some of the larger investors that are in a similar preferred or a similar share class as you. There's a lot more technicality behind it, but simply you're kind of grouping a bunch of people together. It's making sure that small investors can't hold up certain rights or certain decisions.
Okay. No, that makes a lot of sense. And the last one I wanted to talk about is board rights. So when can I expect as an investor to have a board seat? Should I expect to ever get a board seat? What does that look like?
As an angel investor?
Yeah.
As an angel investor, there's always the asterisk on everything. Frequently what I say is you are such a small shareholder, you probably should not expect a board position. Advisory board position, helping those things, at the earliest stages, but a fiduciary board governance board position, probably don't expect that. This isn't private equity. You're also not bringing $1 million to the table. And so in many instances, I would say probably do not expect a board seat. Likely let that exist as someone with institutional capital who does this on a day in and day out basis, that is their job to do so. That's likely the people who will get a board seat, not you, the $5,000 angel investor.
That's fair. So, in your experience, what kind of terms have you seen either negotiated or not negotiated that have caused problems down the line for investors?
Yeah, so part of this is a balance of these. We talked about the liquidation preference earlier. 1x is very standard in the market. And so if you have, let's say, a 2x or a 3x liquidation preference, especially at the early stages, these founders at some point in the future are going to need to raise funding at some point in the future. And so if, for example, I get a 3x liquidation preference, I as an investor, I'm in the driver's seat. I've got a really nice downside protection that exists there. However, that may shoot myself in the foot when it comes to future investors looking at this company, looking at this capitalization table and the rights that exist with those existing investors, and they simply may look at that and say, oh, I don't like that. That's not market. I'm not going to invest. And so you kind of you put your founder, your investment in really a precarious situation if you go too far out of bounds on market standards. So there's a great few different places, NVCA, Cooley, and a few other places that you can find what's sort of in market terms for a lot of these terms that are going to exist in a term sheet.
So along that line, what are some red flags in a term sheet that an investor should pause or take note of?
Yeah, it gets kind of very technical on some of them. Liquidation preferences above 1x, you have to kind of ask what's the reason for that, and what's the driver around that. Are we going to set ourselves up for failure in the future? Valuations that are out of market, you can go to Carta, AngelList, some of these other places to sort of understand where these valuations are. And it's not that necessarily you can have too low out of market and too high out of market. And so I would say valuations, previous valuations that are just really out of market are a pretty big red flag, and liquidation preferences above 1x are pretty question marky, I would say.
Yeah, no, that makes sense. So I do want to kind of circle back to valuation and hit that one hard. So pre-money versus post-money valuation, what does that mean? What's the difference? How are we calculating that?
Right. So the easy way to math this out is I'm on Shark Tank, and I want to put $1 million into a company, and I want to own 25% of the company. So let's just say $1 million buys me 25% of the company. You backwards math your way into the company's worth $4 million, right? $1 million, $4 million, I'm owning 25%. So when we think about valuation, post-money valuation is the equity value of the business before I put any money in, plus the money I put in, right? So in that example, the pre-money valuation is $3 million. I stuck $1 million in there. The post-money valuation is $4 million. There's some sort of strategic components on when you as an investor would use pre-money versus post-money in how you're representing the valuation of the company. The good news for us angel investors, most frequently, is there's going to be some institutional investor or a VC that's probably going to set those from the get-go. The only thing you really want to ensure is that when someone talks about valuation, are they talking about pre versus post? Because, an example, $2 million at a $2 million valuation. Well, if it's a pre-money valuation, then that is 50% of the company. $2 million pre-money, $4 million post-money, half of the company. If it's a $2 million post-money valuation, you're buying the whole company, right? So it's a very different discussion on that point. So it's an extreme example, but just having a level of clarity around that is helpful when you're talking about what valuation.
Yeah. You touched on this a little bit ago, but I want to circle back to it and make sure we really answer this question, because it's the $1 million question, which is, how do I know when a valuation is inflated or just incorrect?
Yep. It is especially at the earliest of stages, there's a lot of people that would say that there is a science to this, right? You do a discounted cash flow model, you end up with a number that spits out on the other side. The honest answer is it's a lot more art than science at the early stages. The good news, though, is there are platforms and databases like Carta, like PitchBook, like AngelList that send out quarterly updates on what the market looks like at certain stages of businesses. Here's the rough range, even with percentiles, of how companies are getting valued today, by industry, by region. It's wonderful data. Utilize those as much as you can. You want it to be fair, and you also are trying to hit this Goldilocks where it's not too low and it's not too high, because both of them are going to set you prospectively up for failure in the future. Simply utilize those resources and go find what does market look like and bring those to the negotiating table if you're an investor or a founder.
Yeah, absolutely. So the next thing I want to talk about is this relationship between valuation and price per share and how they interplay.
Yep. So if you are a public markets investor, you hear the phrase called market cap, and that really is the value of the company. And it is simply the price per share times the number of shares, right? So your valuation and your price per share, very simply, is your price per share times the number of shares is equal to your valuation, right? So the way that we in the private markets mostly think about this is, I understand what my valuation is. That's the thing that probably you're gonna anchor on the most, and then from there you find some backwards math on how many shares are existing in the company, and then you work your way into what a price per share is. Because every company has a different number of shares, there's no real reason why $1,000 per share for one company and $2 a share for another company they could be worth the exact same thing because their valuations may be the same. So really, you as an investor probably spend less time on the price per share. Think about this in terms of valuation, and then your price per share is just really helpful for legal documents and that type of stuff.
That makes a lot of sense. So similarly, I want to dig into this concept of like dilution and valuation and how they interplay.
Yes. And so dilution simply is you as let's say you are the owner of a company, you own 100% of it. You're the founder that's pitching on Shark Tank, and Mark Cuban gives you $1 million for 25% of your company. You now own, instead of 100%, you own 75% of the company. So you basically took a 25% dilution in your ownership of the business. So every time you as a founder raise money, you give away new shares of the company, you give away a chunk of your company, your ownership percentage continually goes down. And so that's one way that you can see dilution as a part of the company. Also, you as an investor, if you invest today and then other investors invest 2 years from now, you, as an existing shareholder of the business, could also get diluted. Along with the founders, you're going to get diluted and your ownership share is going to decrease. So let's say I own 10% of the company today. 2 years from now, they give away or they raise capital and they give away another 10% of the business. I no longer own 10% of the business. I own 9% of the business, right? I'm getting diluted 10% along with everybody else. And so that's really how those two interplay. The other way that you could get diluted, and it's really more of an existing dilution, is we as a company want to bring in amazing talent and amazing people. And so frequently embedded in that capitalization table and the equity ownership of the company, there's this little bucket of shares called employee stock option pools. And we really use those as incentives to give away those stock options to bring amazing talent into the team. Mm-hmm. Now, they're not shares today, right? So you, if the company were to sell today, if you didn't use any of those shares, then you don't have to worry about them. But as the company continues to grow, you're likely going to be giving away some of those shares. They're going to get added to the cap table, and so that's going to continually dilute you as well. It's a positive reason to do so, but it's something you have to just be considerate of whenever you're thinking about how much of the company do I actually own.
Yeah. So I want to go into talking about the capitalization table and kind of what that looks like. We talked about it earlier, but can you explain like more in depth, what does a cap table look like? What are all the components of a cap table? Yep. How does it play out?
Yeah. So it could exist in like a piece of software called Carta. I'll use an Excel file as an example. At the very beginning of the company, you had founder 1 and founder 2 that each owned 50% of the company, and there's simply rows of ownership, and you've probably got columns that are like how much money I put in, what ownership do I have, what number of shares do I have. And so that's sort of, first few columns. And then at some point in the future, they raised a little bit of money. You added people to that capitalization table. They now are new owners of the business. And so you now have what are the current ownership, dollars, number of shares, percentages, with this moment in time of what the company is. And so you can almost view this capitalization table as a history of the ownership of the company, almost like a chart, like a ledger of historical ownership and how it changed over the course of the company. You're going to likely see owners get grouped in a couple of categories. Common shareholders, founders, early employees, you kind of are last to the dog bowl, like you have the least amount of rights. You then have your different fundraises, so my pre-seed raise, my seed raise, and everybody, all of the investors that came in at those different times. And then down at the bottom, we also talk about those stock options, those employee stock options that at the very bottom, they'll get added in there. And then at the bottom right, you've got 100% ownership, total number of dollars in there, and you kind of have the matrix of who all's involved with that at that point in time.
Okay, so how all of that goes together gets tricky very quickly.
It does.
And we're not going to go through cap table math today.
We should not. Do you have another hour?
Yeah, I don't think we have time to hit that today. So, but I do want to talk about what's the best way to manage that. Like as it gets tricky, we have a stock option pool. Things start getting diluted. How do we navigate what that looks like? How do we do best? What's the best practices around cap table math?
The way that I think about that is really twofold. One is use software where software is value add. Carta, there are many other ones, but Carta is a standard in the industry that will help manage who owns what at what time and manage that whole process. The founders will utilize it, and you as the investor may also utilize that as well. And the other part of this is, especially when you start to think about later stage fundraisers, a seed round, a Series A round. The good news is venture capitalists usually have really good lawyers, and they're the ones that are going to be likely doing a lot of this. You should check to make sure that all of this looks and feels right, but the good news is most of the time they're going to do a wonderful job at doing this Excel math problem. So you as an existing and small angel investor don't necessarily have to do this. And especially at the earliest of stages, it's going to be pretty simple anyway. And especially if you're investing on a safe note, you may not even have to worry about it at that point. So anyway, the good news is there are professionals and software that can help you with a lot of that.
Well, thank you for taking some very complicated topics and boiling the ocean for us. You're welcome for not getting into cap table math or doing anything crazy, but I appreciate you being here with us today.
For sure.